Welcome, everyone. I'm Angelo Robles, to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. Today's podcast is titled Advanced Tax Mitigation Strategies for Families and Their Family Offices. To give some context, we're recording this on July 9th, if I have my dates right. Why that's a little extra important? Well, one, you may hear this at some point in the future where the tax laws are completely different, but the traditional filing by usually April 15th, of course, for this year with COVID-19, has been extended to July 15th. So it is a little more pertinent. We're very fortunate to also have two accountants on our Zoom video and call today, and they're incredibly busy. So getting their time, we greatly appreciate it. We have multiple featured guests today. So let me briefly introduce all of them. We have Thomas J. Handler, JD and PC, partner at Handler Thayer, LLP. We have Mike Packman, principal at Keystone National Properties, and Dan Morris, senior partner, Morris and D'Angelo, and Steve Geller, partner, Morris and D'Angelo. We are going to be sequential with our guests today, effectively as I read them off, because Dan and Steve are with the same firm. We'll kind of combine them to be the third among the three. And they have a very tight schedule. So we're going to do the best that we could in terms of making it all happen. We have a lot to cover with some amazing guests. We're very fortunate. Broadly, I'll start off. Welcome, gentlemen. It's a pleasure to have you all on today. And we're going to begin again with Tom Handler, JD partner and Handler Thayer. Tom, how are you?
I'm well, thank you. Pleasure to be with you.
Well, thank you. How does the current environment affect tax planning overall, and what are the trends that you're seeing?
Well, we have a extraordinarily unique situation that I don't think any of us have experienced before, between the unexpected COVID environment that's creating havoc and making the economy much more challenging. We have the lowest interest rate environment we've seen in over 50 years. We've got political bipartisanship that I've never seen in my life. And we've got an election coming up this year to add more complexity to it. And the terms of the proposals in that election are very interesting. So first, to pay for all of the loans and handouts from COVID, someone's going to pay for that. So regardless of who gets elected, there's a good chance taxes are going up at both the state and federal level because they almost have to. But the Biden tax proposals certainly should be a cause of interest to people. They're going to fall squarely on the heads of businesses in the top 10% who are going to pay for almost all of it. Some pretty scary proposals in there. And of course, other Democrat proposals include doing away with the Schedule A altogether. So no more medical expenses, charitable deductions, real estate tax deductions, so on and so forth. So it could be a very new day. So in this environment, the writing is on the wall that we're probably likely in for tax increases next year, regardless of who wins. If the Democrats take either the Senate or the White House, the proposals are pretty egregious, and so taxes will go up precipitously. And the concern is that the estate tax exclusion might not survive either. So I think 2020 is going to be a very busy year for tax planning, and I think increasingly people need to focus on it sooner rather than later, because the fourth quarter is going to be very busy indeed.
Yes, that's quite a bleak picture that you paint there, but I think that's just giving an honest assessment of the situation that the coronavirus has put us in relative to significant unemployment, to bailouts like you noted, and to other aspects where the deficit keeps on going up and up and up and up. Yeah, we're in a low interest rate environment, but this is going to have to be paid for somehow. It's just simply inevitable on both the state and federal level that taxes are going to go up. So let's go a little bit into, okay, given that scenario, And relative to where we are now with the tax laws, what are the most compelling income tax strategies now being used by affluent families and their family offices?
Well, I think that there's probably 6 or 7 things that are getting more focus than others, but I think tax planning is a lot like blocking and tackling. You have to pick up the nickels and dimes on the couch. So I think almost any approach is warranted in this environment. I think that opportunity zones in particular have garnered interest. There's some real, particularly beneficial provisions there, particularly for long-term investors. The TCJA eliminated approximately 50 deductions that are no longer available to individuals. That's causing a lot of family offices to restructure, embedded family offices to restructure as formal entities in order to get these tax benefits. And the family holding companies run by those family offices need to be integrated into a comprehensive structure in order for that to be effective. So there's an awful lot of that planning going on. We're seeing people focusing on taxpayer flight, which includes moving from high tax blue bankrupt states like Illinois, the highest overall taxing state and the most bankrupt state by far. And of course, we've lost the most businesses, trusts, family holding companies, people and capital per capita over anybody, which of course is not surprising. And the beneficiary states tend to be more conservative states that are fiscally responsible with a lower no tax environment. So the big winners tend to be places like Tennessee, Texas, Florida, Arizona, at the expense of New York, California, Connecticut, New Jersey, Massachusetts, Minnesota, and of course, Illinois. The particular tax program, the beneficial tax programs in both the Virgin Islands, the US Virgin Islands, and Puerto Rico are of interest. They are the lowest potential rates available, but of course, you have to reside there. But those are gaining interest. And I think under the TCJA, the new GILTI tax is a particularly favorable rate, particularly for international players. They can get down to a 10.5% rate. So a lot of companies are trying to restructure to fit into that mold. And then the typical strategies, maximizing qualified plans and preferential provisions like IRAs, Roth IRAs, 529 plans, anything that'll defer a tax or eliminate a tax is of interest. A lot of planning with life insurance, annuities, private annuities, and then using some of the more advanced strategies layered on top of that, private placement, which eliminates income taxation on the underlying assets, split dollar, generational split dollar, and of course, premium financing. There's an awful lot of activity in this regard going on right now.
Yes, and among the things that you mentioned, we'll focus a little more on opportunity zones with Mike Packman coming up shortly, but certainly that could be something of interest. You did mention a topic that we've covered before, haven't covered too much lately, and that would be it's in the tax code, the tremendous tax benefit of Puerto Rico and the US Virgin Islands, the Caribbean broadly. Those two territories have been hit very hard. From the economy to the COVID virus to hurricanes, natural disasters, etc. I did wonder, and those never really took off as much as perhaps those of us from the outside looking in would have thought. Do you think, depending on political issues, although technically I know it's a tax treaty, are those going to come under more scrutiny as more people potentially do them, because they are amazing tax plays for US citizens?
They are. So we've had mixed experience. Puerto Rico, of course, was first to the table. And so, I'm sorry, the USVI was first to the table. So there are more of those ECD enterprises and taxpayers in existence. And a lot of people tried to play games with the law that in an inappropriate manner. You'd have 5 guys renting a condo, claiming citizenship in the USVI. Well, of course, 5 or 10 guys can't live in a 1-bedroom condo, so that's kind of ridiculous. If those who actually moved there and pumped money into the jurisdiction did it in reality, and the company was there doing what it's supposed to, meeting the rules, then those likely worked out. I will say that make no mistake that the tax authorities in the USVI in Puerto Rico are far more favorably inclined toward these provisions than anybody at the IRS. So there's a little bit of a conflict between the service and the local authorities and the territories, but these jurisdictions have been hammered pretty hard. There's an awful lot of welfare. It needs capital, it needs investment. So I think this is a wise provision, the ability to have these benefits. And I think it'll ultimately make a difference. I think they have attracted businesses. And the long and short of it is that if you can park a company in Puerto Rico or USVI, and it generates revenue there and operates, creates jobs, and you are a shareholder in that company and you live in the jurisdiction, you can qualify for a 4% tax rate, which is wildly, beneficial. So it's designed to have a direct subsidy of that jurisdiction, having people living there, spending there, creating jobs. And that's typically a far more effective subsidy than the government getting the money, having it go through the bureaucracy. And we're lucky if we get 20 cents on the dollar in the hands of the people. So this direct subsidy is probably much more efficient. It will actually cost the taxpayers less money. So if it's real and done according to the books, it should work and be effective. And I think as tax rates get more onerous, these territories become more attractive.
So you mentioned some things that are relatively straightforward, but those are really, really important to do, the ones that are right underneath your nose. That may be state arbitrage for the reasons you noted, mainly let's look at Florida, quote unquote, and or Texas. Contributions to qualified plans, to 529 plans, with a little bit of the caveat is who knows what the income tax rate is going to be on some of those like qualified plans when you're making a distribution. So that is a little bit of a crystal ball issue, but on the surface looks logical, at least at the moment. You went into some more advanced strategies, the potential move of company and personal to the US Virgin Islands or Puerto Rico. For families that have significant alternative investments, considering a private placement or private placement, both life insurance and annuities as a tax deferred wrapper. Of course, private placement life insurance will have other benefits as a life insurance policy as well. And some of the complexities of split dollar and premium financing are going to be more advanced strategies that we may need to do a deeper dive into. But along with that, what are other advanced estate planning strategies for affluent families that you could be focused on right now in 2020, primarily probably due to dislocations in the market, although bounce back, and the incredibly low interest rates that we have right now?
Well, I would argue that between the low interest rate, a likelihood of rising tax rates across the board in 2021, incredibly low valuations largely caused by COVID distress, and coupled with the largest estate tax lifetime exclusion amount in history at over 23 million and its index per couple, that's just a gargantuan amount. In my practice career, that number was 150,000. It was 400,000 for a period of time. So to be at 23 million is almost unbelievable. I never thought I would see it. And most practitioners don't think we'll ever see it again. So I don't have a crystal ball, but if I were a betting man, I would bet that that lifetime exclusion amount is not going to stay at the very generous level that it's currently at. I think that we've got an environment that has vilified wealth and accomplishment and entrepreneurship and education. And part of the end result of that, largely out of ignorance, is going to be, well, let's take it to the top 1%. And the estate tax is a great way to do just that. So given all that, I think the primary moves are using leverage discounting strategies to affect very large transfers. So one, we're recommending that people use up whatever exclusion they have left right now while it's still there, but certainly in 2020. If you wait to 2021, there's a good risk it may not be there. And that exclusion amount at roughly 23 million can be leveraged up. So if a transaction is done where you make a cash contribution to a dynasty trust or an intensely defective trust and purchase discounted interests out of family holding companies, typically we've been seeing 35% plus discounts after IRS examination. And then you've got a long-term note freezing the assets in the hands of the older generation at these incredibly low AFR rates, 1%. All of the appreciation is going to the next generation. the full amount of the discount completely escapes estate tax. And so the biggest transaction you could do is about $355 million, of which you'd have about a $210,000 note, and the rest of those assets are completely out of the estate. So you can dial it up or dial it down as appropriate. So the uses primarily are grants, grant to retain annuity trusts, dynasty trusts, and intentionally defective grantor trusts. And any one of those can be used in combination with a family holding company with a discounted asset. With a sale transaction, it allows you to use an installment sale at these very low AFR rates and in effect create an estate freeze in the older generation, which is very powerful. So getting the appreciation out, getting the discounting, benefiting from this low interest rate, it is the perfect storm for estate planning. And there's a good chance that the fourth quarter of 2020 is going to look a lot like the fourth quarter of 2012, when we were working 15, 16-hour days, 7 days a week because we couldn't keep up. That could potentially be in store. Much is going to depend on the election. But if any of the things that I predicted happen, these moves are going to be more impactful than they otherwise would be. And just plain old discounted gifts are a solid strategy for even the regular millionaires. If they've got family holding companies, the ability to give a $10 million gift that only counts as a $6.5 million gift is pretty impactful. And then because of the risk that people are feeling, we're seeing a lot of risk management moves. Captive property and casualty insurance companies, domestic asset protection trusts, international asset protection trusts, premarital, postmarital planning have quadrupled through inbound phone calls with no effort on our part. I think those are all indicators that people are feeling confused, they're feeling fear, and they're feeling anger at all the things that are going on around us. It makes for a very volatile environment. And when people have those kind of feelings, they tend to run for cover. So there's a flight toward conservatism, a flight toward safety, and all of those things are going to drum up more estate planning between now and the year end.
Very good points. Perhaps my last comment question for you, Tom, although it's getting a little bit off base relative to tax mitigation strategies, but you mentioned the importance of asset protection and effectively wealth transfer, which arguably as a 1-2 punch may be about the most important consistent goal for many families of great wealth. In the US, for a US citizen, offshore asset protection trusts are not going to be much of an income tax play at all, but you're not doing it for the income tax play. You're doing it for other purposes relative to privacy and to make it more difficult for a creditor. We have a limited amount of time, but if you could maybe explain the benefits of that in 90 or so seconds, that would be important.
Certainly. So years ago, there was an opportunity and there were some income tax benefits to having foreign trusts. Those are long gone. So the anti-deferral regimes have shut those down. There are several multi-billionaire families that I know of where every single trust is international. There are no domestic trusts, and they are purely for asset protection and premarital planning. So you're correct. These trusts today are income tax neutral. They're fully reported. They're fully compliant. They're filing the appropriate forms, checking the box, doing what they need to do, and they are purely there for a start-over fund or to avoid marital problems. As the family law courts have gotten more aggressive, alimony payment terms have gone from 1/3 the term of the marriage up to perpetuity. The family law courts have invaded non-marital property and non-marital trusts. They should not be able to invade. I think it's a violation of the law and the Constitution, but no one's taken those cases up yet. So in an environment when people are concerned about overreach on the part of courts or government or plaintiffs and class actions and divorces and all the many threats that are out there, asset protection moves to the forefront. And the international structure is greatly superior, although quite a bit more complicated to put in place because of FATCA, Dodd-Frank, Patriot Act, and Know Your Customer. It's an expensive proposition, but if you want to make sure that you have some assets left over, there are 2 jurisdictions, treaties with the US, compliant, not on the OECD, FBI, CIA, or Treasury blacklists, where no trust has ever been broken. So there are places to go where you can rest assured with a very high degree of certainty that you will have a start over fund. And for families of affluence, they should absolutely be considered. They're not for everybody, but they should take a look at them and consider them.
For sure. And we've had Tom on before and discussed some of those jurisdictions. We're going to leave that a little bit of a hanging note there that we may pick up on a little bit with Dan and Steve a little bit later. But I do remember what those two were. If you go back and listen to my prior podcast with Tom, you'll be able to figure that out. Why don't we move on to Mike Packman? Mike Packman, how do the potential changes to the tax code affect real estate?
Hey, Angela, how you doing?
Great, Mike.
So yeah, there's a lot to consider. And real estate has been one of the most tax advantageous asset classes out there. And between 1031 exchanges and opportunity zones now, as well as conservation easements or the donation of property, there's a lot of ways, and then all the depreciation that you can take on your real estate assets. So as Tom had mentioned, with so many things up in the air, you just, everything's potentially on the table, right? So even something like 1031 exchanges that have been on for real estate for a very, very long period of time, and everybody's always counted on, although I guess it was 4 or 5 years ago, there was talk of them taking 1031 off, which they did when the opportunity zones came out. They actually took off exchanges for anything except real estate, but they left it on real estate. And I actually remember I wrote an article back then on what the potential effects would be just on the economy overall if they were to take 1031 exchanges out of real estate. And from the research that was done by some very smart people at Ivy League schools, said that it could be worse than 2008 for the residual impact if they took exchanges out of real estate. So that's obviously one thing to consider. Number one is if they did take 1031s off the tax code, what would that do to prices of real estate? It could substantially reduce the values of real estate assets. And then the other part of that is if you think that might happen, if you're thinking of selling a property, maybe you do that exchange now into a property you think you're going to be, you'd rather own for, if you end up stuck with an asset that if you have pretty much no cost basis and you're in an asset that you're considering selling, and there's another asset that you wouldn't necessarily mind owning pretty much forever if exchanges did come off the code, maybe it's time to sell that property and exchange into the new one today rather than later. So, I think a lot of people, as Tom mentioned, are, going to be making decisions this year to do things sooner rather than later. And that goes for, on the opportunity zone side, as you had mentioned before with retirement accounts, Angelo, it's unlike a 1031 exchange in an opportunity zone, you are going to pay those taxes in 7 years. So or at least the majority of them, you should get a 10% discount, but you'll be paying taxes on 90% of those taxes are going to be due. And what are those tax rates going to be? So when you're considering, if I'm selling a piece of property, do I want to do a 1031 exchange or go into an opportunity zone? That's something to consider, is what if the tax rates are substantially higher when you have to pay those taxes in 7 years? Now, on the flip side of that, if you hold the asset 10 years or more, it's like a Roth IRA, your gains are unlimited. But if you do decide to sell, then what you go into at that point, you wouldn't have paid tax on the entire gain on that property, but what you decided to go into in 20 years from now, whatever tax rates and tax laws are then you'll have to deal with. So just interesting things that you need to consider on what avenue to go on and the different potential advantages and potential disadvantages to what might happen. Again, none of us know until those changes come in, so we can all make our best guess and kind of decide what we can live with, which decision will be easier to live with, on our best guess of what those changes will be.
I mean, so I guess you might be rethinking strategies around some of the assets you thought would never sell, but due to COVID-19.
Yeah, no, I mean, perfect example, look at like Manhattan real estate. It's, we have an office in Manhattan. Tom, you and I actually had a conversation about this in the beginning, both of us, paying substantial rates on our respective offices in Chicago and Manhattan. And, there's nothing we can do. We thought, we have to pay those rates for now, but, I'm not rushing. My lease is actually up in May, and I'm not rushing to think, yeah, let me go re-up that lease. And, if, whatever we decide, our rates are going to be substantially lower than what we paid on that lease originally. So, if you own an asset in, for example, Manhattan, that you thought you would never sell, well, that's definitely potentially changed now. So, assets that people thought that, could never, they would never go down in value, or if they did, it would be a short-term blip, and the income you can just count on forever because nothing's going to change that. All of a sudden you get a pandemic like COVID, and then just the change policies by some of the largest companies in the world that don't care if their employees don't go to an office every day. So, the world is a very different place. So now, again, that brings up that question is, if you might have a building in Manhattan or Chicago or LA, wherever it may be, any major city that you have no cost basis on. Yes, it might have gone down in value than where it was 6 months ago, but you still have a substantial gain, and someone's still willing to bet that will appreciate at some point from here. And you can get a good enough price, and there's something that you feel more comfortable with. Now you have an asset that you didn't think you'd ever consider selling that, maybe you do now. And then again, do you look for an opportunity zone? Do you look to do a 1031 exchange? What are you going to do to mitigate those taxes if it is still a substantial gain?
Well, that basically leads into my next question for you. And for sure, what you're saying about Manhattan real estate prior to us understanding something like a COVID-19 coming along, never would have thought that it could have such a potentially drastic impact. And we've had multiple real estate experts on, some that think it'll bounce back and recover better than ever, whatever, 3 or 5 years. They might be right. But I definitely have had people come on and say, listen, what's going to happen in New York City for a variety of reasons, with enhanced regulation, with increase in taxes, with the fact of companies are working relatively well remotely, may be a tremendous boon for Florida and Texas for reasons that Tom noted, and not as much for New York. And I'm a little on the fence. I'm not 100% sure, even looking 10 or 15 years out, that certain aspects of commercial real estate are just going to come back and be what they were historically. I'd be a little concerned. So you did bring up, if you do decide to sell, do you go with the 1031? Do you go with an opportunity zone? What are the advantages, disadvantages in the new higher rate environment, I guess I could say?
Yeah, that's, obviously if you're selling, a business or a stock or any other highly appreciated asset that you don't have a choice to do a 1031 exchange, and the only way to defer those taxes is by doing an opportunity zone, then you pretty much have no choice. But when it comes to real estate, a lot of times, and just from my own analysis, a lot of times it's just easier to do an exchange than to jump through all the hoops on an opportunity zone. If you have that availability to do the exchange, especially if there's another property that you'd be comfortable going into. Again, now there's even another reason to evaluate more is, one, if you go into the opportunity zone, you're going to end up paying taxes at potentially a higher rate. However, if you do an exchange and they take away exchanges, and 5 years from now there's no more opportunity zone to go into, and there's no exchanges, now you are going to eventually pay those taxes, right? Whereas if you went with the opportunity zone, at least that particular property, if you hold it for 30, 40 years, you can end up, all those gains will be tax free. So it gives you another layer, I guess, to evaluate not just what's now and what we thought would be foreseeable future. Now that foreseeable future could have a very different picture than where we are now. It just brings other questions into the equation to evaluate.
I mean, I suppose another real estate play, but it's deeper than that from a potential income tax benefit, potentially, is conservation easements. If considering, does it make sense to donate now so you have the 15-year carry forward to use in a higher interest rate environment?
Yeah, I mean, that's another thing that's, if they were to, as we talked, anything could be on the chopping block to come off the tax code. So if they were to take conservation easements off the tax code, if you had a piece of property that you've been considering donating and it's a substantial deduction, even if you don't have the income this year, you can carry it forward for 15 years. So you might consider donating that property today and having it to use if income taxes are substantially higher in years to come. You'll get a huge benefit from that. One point though, if they get rid of Schedule A and you can't use those deductions anymore, then I guess that's another thing to consider too. I mean, it's just really interesting from both, just from an economic standpoint overall, because of COVID, nobody knows, anybody's guess is as good as anybody else. It doesn't matter what an expert you have been, this is a completely new world we're in. And then you throw in the, huge potential tax changes in part because of that also. It's just, it's really anyone's guess. And, obviously you're going to have to make some decisions to do, to prepare yourself as you best see those, what those changes might be. So it is a very interesting time. And I guess you just kind of have to hope that the decisions that you make, things fall in line and they've worked out the best for you and how everything plays out.
One of our live audience members has a question. Can you comment? And you kind of did that. Everything is going to be on the chopping block, but maybe a little bit more on the threats of the IRS relative to conservation easements, and maybe specifically a case they note that I believe is pronounced the Plateau case.
Yeah, so I see the syndicated easements. I see actually the chat box there on the syndicated side. Yeah, I mean the syndicated side of easements have been a hot button for the IRS. Tom, you mentioned captive insurance companies earlier. They're a listed transaction just like the captive insurance company. Captives also. There's a lot of captives that might have been done questionably, but if you do them correctly, they can be a great way to reduce your income taxes. Same thing with conservation easements. There's like any part of the tax code, I'm sure there's people out there that have taken advantage and not done things correctly. If you do a syndicated easement, if you follow the tax code and you do things correctly and they're legitimate deals and you're conservative with your valuations and you have legitimate appraisers, they can be a great way to mitigate your taxes as well. Yes, but the IRS has been wanting to take the syndicated easements off the tax code for years now. So, so that's obviously a potential, but just even conservation easements in general could, if they're talking about putting 1031 exchanges potentially out there to take off the code, it's pretty much anything's fair game in real estate, I guess. Getting rid of Schedule A. It's anybody said it's pretty much anyone's guess as to what will happen. So, whatever planning you're thinking of doing, probably a good idea to do it over these next few months. And this way, at least you didn't look back and say, well, I wish I had done that. So at least really lay out your options, talk to your advisors, your CPAs, your attorneys, your trusted advisors, and see what your options are, what the potential benefits, what the potential risks are, and at least so that you give yourself the opportunity to make those decisions, not when January comes around, you say, oh, wow, I didn't even look at this and I stuck my head in the sand and now all my opportunities passed me by.
Good points, Mike. Mike Packman, thank you very much. Before we move on to Dan Morris and Steve Geller, just a little bit of a note from me. These are very complex tax and wealth transfer discussions that we're having today, and very much timely at the moment, July of 2020. You may watch or hear this at a future point when the tax laws are completely different. So this is going to be more applicable at the given time that we're discussing them. And these are highly complex, subject to the interpretation of various experts we would have on. So you have a unique set of circumstance. You need to talk, as Mike just said, with your specific legal and tax advisors, perhaps even have a backup and a backup plan in terms of others that you would get their opinion of, because some of these are unique and very, very complex issues. We do this out of a service for members and listeners to spark education and interest. But again, a lot of it is subject to interpretation of the given expert that may be specific to your situation that you talk to. So we're just doing this from strictly a educational, engaging, even bordering on being what we would call an entertainment perspective from the media, which is when I'm doing my podcasting and YouTube is for sure the hat that I'm wearing. Well, We'll now wrap it up, and very excited to, with the before noted Dan Morris and Steve Geller at Morris and D'Angelo. And there is something that we're going to get to, gentlemen, very, very shortly, kind of a newer announcement, which is not a positive to many wealthy families with the IRS. But before we build into that, and again, I know the timing now with the extension being July 15th is really hectic and crazy for a lot of people, but it may be building on or adding to what Tom said when I basically asked him, what are some compelling income tax strategies that families of wealth and resources could do? What would you have to add to that, Dan?
Oh, thank you, Angelo. I think our panelists, we worked well together, and we thought about these. Clearly the long-term consideration is, where do we want to be somewhere around the corner that nobody really knows about? So the best strategies are ones that balance risk as it relates to having your opinions reversed. And the ones, are you better off to pay a little bit of a tax now versus deferral? So clearly basis adjustments or making sure that we don't leave unused basis should we have a family member who's elderly, right? So from a wealth transfer standpoint, to the extent that we've got passive or portfolio assets and you're in a state that taxes, can you move those to even domestically into a trust in South Dakota or something like that, where at least you can defer the recognition under that recent North Carolina tax court case or a U.S. Supreme Court case as it relates to being able to defer recognition until distributions? What can we do to convert anything that's ordinary to capital to the extent possible? A couple of things I think that's really important. There are some highlights that I think Stephen and I believe in greatly. One of those is a concept that I've coined that's called the New York Times, Wall Street Journal's Forbes syndrome. And in essence, that says about 2 years from the time that the New York Times publishes something on its front page is about how long it takes Congress to react in a way to probably remove that benefit. So if you think about when New York Times disclosed Apple's double Irish Dutch sandwich, and all these people were coming up to me and asking about these questions, but it was Google and Starbucks and Amazon and all the strong tech companies had great advantages, because we don't believe in loopholes. We believe the code was written to take advantage of. But when the common person in Peoria believes that it's been abused, it takes Congress about 2 years. So that's kind of a clock. So hence conservation easements, right? They're a great idea when done appropriately and right. But then some people were a little greedy, so to speak, and then they've gotten disclosed. So I think that's something that's important. I think that harvesting, making sure that we've allocated those asset protections, whether they're domestic or foreign trusts. Forget the income tax, just the privacy. I represent a number of foreign trusts. We've dealt with those on other podcasts, and the litigation avoidance has been worth every penny. They don't care about income tax. They just care about stopping aggressive plaintiff counsel from knocking on their door and seeking money. I think to the advantage that you've got things that I would concern myself with today. Recently, a couple of years ago, there was a case called Wayfair that undid a permanent establishment that was under Quill. And so now you've got more families who've got more businesses that are operating across states that historically they didn't report in, and today they probably do, both from a sales tax and an income tax allocation. I think those are kinds of things that are important. And I want to toss this to Stephen in a second. I think that your comment about multiple opinions is an outstanding aspect, not from a competitive advantage, but when we've got different perspectives and different brains in the room, there will be a better outcome for the family, because those of us who are advisors, we know what we know, and we have our own inherent biases, and that doesn't make us evil or superior. It just means we see the world differently. And whether I receive it from another firm or other lawyers, or I challenge lawyers or other accountants, to clarify their thinking, we get better outcomes. And I think that the wealthier we are, the greater that we need to have that kind of conversation. Stephen, I'm going to toss it to you because I think you've got some good ideas.
Thanks. This is a really tough panel to be the final speaker in because pretty much everything I had on my list has already been mentioned, but I'm going to go back to a couple of items. First of all, Dan, I have to agree with you about the multiple opinions because right now there are some amazing opportunities for tax planning and estate planning. And there are some really smart devices out there that people around the world have come up with. So to rely to, I don't want to say shop, but to get educated as to various different routes is certainly in your best interest right now. There are some things that we either touched on or I wanted to mention. Mike, you gave a great discussion of opportunity zones and the choice of whether to do or not to do. But what about the opportunities within opportunity zones? You don't have to just use it for real estate. Obviously, we can do some venture capital within it. We can buy assets within it. So there are other opportunities or variations on the opportunity zone theme. And what I like about opportunity zones is that, yeah, we get the discount on it, but it is like a Roth. And the opportunity zones are unusual places. Some of the best real estate in the United States is in opportunity zones. Downtown San Jose, where our main office is an opportunity zone. This is some of the most expensive real estate, certainly in the West Coast. I don't think that we have seen a better opportunity for dynastic planning than we've got in front of us right now. And this crosses into income tax planning also. The opportunity to whether to recite your assets into a tax favored state, to protect your assets, to avoid what will be we know will be an increasing estate tax and a decreasing exemption by statute in 2026. But yes, in all likelihood, we're going to see a dramatic decrease in that, I think, in the next couple of years. Combine that with rock bottom interest rates, a depressed market for investments, i.e. all leading to bigger discounts. So I think that that's a great opportunity. We are getting a remarkable number of questions right now from our global customers as to exit planning. Customers who are considering leaving, expatriating back to their original countries, whether it's Canada or European or Middle East, China or India. We're getting a number of these questions and how to negotiate that in advance. We are also getting quite a few questions about people who see this as the calm before another storm when the economy recovers. So how do I position myself tax-wise? And we go back to some of the devices that have already been discussed, whether it's private placement life insurance or deferred variable annuities. I lost my place here. GRATs, CLATs, CRTs, and of course, shifting things into new generations. So a lot of things, I think there's a lot of opportunity right now. The last thing I'll mention, I'll throw it back to Dan, is that I think that you have choices right now. Never do anything for income tax purposes. Income tax is a benefit. We should plan around it, but everything should be considered in economic terms. I think we'd all agree. The economy right now, my opinion is that we haven't seen the worst of it yet, but that creates opportunity. So I would consider that very strategically as how you move forward. Now might be a right time to harvest lower tax rates and exit out of certain assets, take advantage of 15 and 20% capital gains rates and get your basis step up. So sometimes paying tax isn't a bad thing if we can harvest at a lower rate. The last thing I'll mention, I'm going to throw this back to Dan, is we're seeing kind of an interesting evolution in the IRS right now. Not to say that we're going to see a kinder, gentler IRS, but the new commissioner is definitely rejiggering things, to say the least. They're trying to restructure. They're putting a lot of emphasis on large business and international. They're putting a heavy interest in large families, and we've noticed the audit cycle has gotten very long on just normal audits. So with that, I'm going to throw it back to Dan.
Thank you, Stephen. A couple of things I think are, and then we can have great discussions, because I'll guarantee you that the panelists are just, we really enjoyed our calls. You know, in our view, tax and tax policy, Angelo's a lot like what I'm going to call like the cicada, right? You know, they talk about when the cicada comes out, they've been in the ground for 10 or 15 or 17 years, and they talk about that. Well, tax policies are about the same way. It takes 10 to 20 years to incubate these wild-haired ideas, whether they come from, you know, freshman congressmen or if they come from think tanks, to percolate through and get into the code. The Joint Committee of Taxation has a whole lot in their back pocket, but they look for timing to place these in. So I try to remind people who, when the big Green Deal came out or the new Green Deal came out of those ideas, not for today, but those things will percolate over time. So if we're a family thinking about multiple generations, what do those kinds of policy shifts, whether we agree with them or not, they're moving forward. So wealth is being attacked, right? So how do we have those start over funds? How do we think about that? There are some economic things that I think that are percolating underneath that we should always remember about. We have state and local governments that are on the verge of bankruptcy because of pensions and pension debt that's really unrecorded, let alone private pensions that are struggling. We have student loans that many people want to forgive. I mean, ultimately, we can only go to the taxpayer well so often before we have to start raising those interest rates. Mike talked about the Schedule A. You know, they started beating the Schedule A down, and I think in 1986 when we took credit card interest rates and we started to create the passive activity losses. And so people who we started down that path, and we mitigated we created limitations on mortgage interest deductions. And so to remove the Schedule A is simple. If they're going to keep the Schedule A, they're probably going to bring back the AMT on a greater basis. So those kinds of, how do you create aspects? Ron Wyden, who's the ranking minority member of the Committee on Finance for the Senate, actually proposed about a year and a half ago that maybe we move people to almost a mark-to-market methodology as it relates to appreciated capital assets. And of course, the investment advisors scream bloody murder. And while that might cost tax, I will say that, I mean, how many times have any of us who've been an advisor have watched people fail to exit an asset because they didn't want to suffer the costs of the taxes, and yet when they finally exited, they earned less than they would have had they just paid the tax. But things to think about: what happens if we move to a mark-to-market appreciation? How can we shelter that idea as it relates in personally? I do think that we talk about, Stephen mentioned our calls on exiting the country. We're getting a lot of calls on inbounding, right? As immigration becomes a hotbed of conversation, families who want to make sure that somebody has a footprint here. We are the safety zone for the world. So there are planning opportunities there. And finally, you know, I think that we're going to, it may not be until the election, but the Supreme Court earlier today decided that the president's tax returns could be disclosed to the grand jury and other appropriate people. And that's not a political comment, plus or minus, but the moment that the president's complex tax returns become public information, there that whole New York Times, Forbes, Wall Street Journal analysis of how wealthy people have aligned their interest and their assets will come under attack. So we should probably be prepared for certain kinds of legislation to react to that. Again, whether we like it or not, we should just be prepared. So families ought to be in a defensive standpoint, and from a marketing standpoint, talk about the good that they do for the humanitarian effort, how they help people, and some of this is more about what people believe rather than what is. So I think that finally Stephen hit on one major point. The Internal Revenue Service has moved 400 supercharged smart agents to focus solely on wealthy families and their infrastructure, their policies, and how they're doing it. So if you're a family of wealth, let's define that as income greater than $10 million, you're likely to have your structure evaluated in depth. And so today is the day, now is the day to start preparing for that ultimate examination and start risk taking it and figuring out. And finally, one last thing, what advice we tend to give people who follow ideas about conservation easements or something like that. If you take that and you're afraid that there's a little bit of aggressiveness in there, to the extent that earned a refund or reduced your tax, keep that with the Internal Revenue Service until your statute of limitations is gone before you claim it. And that way you can at least avoid interest at times under audit, or at least you have an argument that you're not going to be subject to, since you didn't take the money, you just held it there. It's a policy that has worked well for us, at least from an aspect of time value of money and risks, and of course properly disclosed. I think those are the big things that our panelists. I see that there's a question from Claire, and I'll take it and I'll throw it off to our panelists. You know, captive insurance companies are an excellent risk mitigation tool. They are for those of you who are unfamiliar, they are a single purpose, single customer kind of purpose insurance company. They are regulated. They're an insurance company. They have risk mitigation, but you have to treat them with respect of an insurance company. If there are claims, you have to pay them. You actually have to have actuarial reports. You have to act in behalf. And to the extent that there are tax benefits, those ought to be the 5th, 6th, or 7th benefit that you're seeking. People who abuse captive insurance companies think about, because they can move $2 million or whatever it is away from their ordinary income into a captive, that's a great thing. Focus on the risk mitigation, focus on the risk management, focus on covering things that are real, that may be rare but are real. And then if you get a tax benefit, excellent. But in essence, if you do it for tax motivation purposes, you'll lose in the substantive economic analysis. I'm sure that my colleagues will have additional opinions on that.
I'll just add that one of the benefits of captives is that you can insure, and when I say insure, it's a combination of self-insuring and reinsuring. You can insure for some more unusual things that if you otherwise went to Lloyd's of London for, it would cost you an arm and a leg. So you can create some custom coverages, and we have seen actually in this COVID period, nothing too out of the ordinary, but a lot of benefit, such as business interruption and business decline. So you can create some custom coverages. We have one that we're setting up right now to insure for a personal guarantee on a corporate lease. So.
Well, it's Angelo again, everyone. Those incredible insights, and thank you all so much. And I'm looking at the board to see if there were any other live questions from our live participants. We might have a couple of more minutes left, but a little bit of a comment that Dan also noted. I think for incredibly affluent families where there's so many complexities around wealth transfer, asset protection, mitigating taxes, that doing a stress test. What am I currently doing? has it been updated? Do myself or my current advisors have blind spots? And we all do. That having a second and a third set of eyes, we discussed this with the attorney Tim Lappin yesterday. You may very well have great guidance from your current organization or firm, but it can hurt to play out what if scenarios, disaster simulation, what if this happens, and to stress test what you currently have. Now, the joke in estate planning is you don't really know until you die, potentially. So it's a little bit after the fact. So that creates, before that happens, obviously, again, having a firm that you approach that's like, listen, I don't want you to nitpick and necessarily take the business away from the firm I'm dealing with, but here's what they came up with. I'll pay you a retainer. Could you at least look at it and give me commentary about it? Now, they may poke a lot of holes in it where it causes you to look at your current advisor and maybe want to replace them, or it may be some relatively minor points that you now know about and you could approach them from a more educated perspective. It's a natural tendency, not only confirmation bias, and this has been proven by a psychologist. If I were to ask Mike about his dentist, Mike, is your dentist good? Oh yeah, of course my dentist is good. But how would Mike really know that? Did he go to dental school? Did he go to 300 different dentists, once a week for several years and compared them? He's assuming that because he's a smart guy and they appear to be doing a good job, that his dentist is better than average. But we really don't know that. And unfortunately, that also applies to legal and tax counsel. You just don't know. I've had attorneys tell me that in areas pertaining to legal that they're not an expert on, that sometimes they don't even know when dealing with outside experts if it really has been stress tested and is it really great advice per se until, again, perhaps after the fact. So I think it was important to pound that home a little bit because I think that's an important point. Now is a time to stress test. Now is a time that we're playing out COVID-19 as a what if scenario. And some of the results that some of us are seeing are not so pretty. So this is an opportunity to kind of button up the ship, so to speak, and get it in order. Why don't I go in backward order? Tom, for those that would have an interest in learning more about you and your firm and reaching out, how could they do so?
So our website is handlerthayer.com, and I work out of the Chicago office.
Wonderful, Tom. And Mike Packman, how could people reach you?
Our website is www.knpre.com. So Keystone National Properties Real Estate, knpre.com. Keep it short and simple. And you can go to our website. You can reach out to us. Our contact information is there as well. Happy to have a conversation with anyone who would like some advice or might have some interest.
And for Dan and Steve, how could people learn more about Morris and D'Angelo?
Well, our website is cpadudes.com, and you can also go to the more politically correct one, morrisdangelo.com. But we tend to, CPA Dudes is shorter and
very memorable.
It is, and it's a little bit of surfing culture. So we were an all-inclusive set of folks out here on the West. So yeah, cpadudes.com.
Well, we're very fortunate. We've had great guests on today, and having them in a panel and some level of interaction has been wonderful. Again, like I said earlier, very complex issues applicable per interpretation at the time, month and year that we're in now, that could change so much. And again, subject to a level of interpretation, even during the best of times and current times, you really want to be specific to your scenario and seek out expert quote unquote counsel, as we discussed earlier. Everyone, I'm Angelo Robles. I'm the host of Angelo Robles's Effective Family Office podcast on Apple, iHeart, Spotify, Stitcher, and other platforms. Some of what we do is also up on our YouTube channel. Simply, it's Family Family Office, so Family Office Channel on YouTube. And I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of wealth and their family offices. We do a significant amount of original proprietary content, really now more than ever, and host global programming on hold, but we're doing near daily programming, so hundreds of times a year, digital and online programming like today with deep thinkers, thought leaders, with family offices, with family principals, political leaders, you name it. It's been an incredibly active last 4 months for us. We've never been busier, doing great in terms of interest with families and those reaching out, and hopefully providing real value to them. The big thing that we have upcoming this summer will be the rollout of what I think is going to be the most comprehensive online masterclass on creating a resilient, anti-fragile SFO. I've been working on it theoretically for years, but the last 4 months during COVID, it's really evolving greatly. And I'm very luckily for me, have some wonderful thinkers and thought leaders globally that have been helpful for articulating or clarifying my thoughts, and it's rather comprehensive. So lots of original thought leadership coming from us. Stay tuned, specifically more so for my members. On that note, I'm very active on social media. I could be reached at familyofficeassociation.com as a website, and Angelo at familyofficeassociation.com is preferred email. Thank you so much to our guests, our live participants, or listeners, and those that will watch this on YouTube or hear it on a podcast. Thank you all so much. Thank you, everyone.